All right, welcome everybody to the Confido 2026 State of the Markets. 2025 was most certainly the year of artificial intelligence, and so as such, I used AI to generate this very cool image that you see in front of you for the intro slide. Um, and like I mentioned a moment ago, we're supposed to be joined by one of my colleagues from Mariner, Jeff Crumpleman. I think he's probably dealing with some sort of tech difficulty, but hopefully he'll be able to join us. I'll jump into the sort of beginning of the presentation, and then we can give Jeff an intro if he's able to join. So the theme for 2025 was CAT, and that stands for Clear Air Turbulence. So the idea was that turbulence, almost never, if never, causes a plane to crash, but it is, a bumpy ride. And that was certainly the case in 2025, right? With the tariff tantrum, we saw the market dip. Officially, it was 20% intraday, 19% at the close, so close to a bear market on April 8th. For good reason. There was a lot of speculation and sort of confusion around where the tariffs would end up. But of course, most investors would be very, very pleased with the results that ended fiscal year 2025. So we saw the S&P 500 with its sort of normal weighting up 18%. But really the bell of the ball was international. The MSCI EFI international index was up 31.9% and emerging markets up 34.4%. There were a lot of sort of, good reasons for what was going on. I mean, strong earnings was a huge portion. Economic growth, GDP expansion, of course. We had cooler inflation than expected. I think there were a lot of people that thought inflation was going to pop up, especially towards the back end of the year, but that wasn't the case. And we ended up with a fairly measured Federal Reserve as well that didn't sort of take the bait from the administration. And I think that gave the markets a lot of confidence as well. And of course, so goes the U.S. consumer, so goes the U.S. economy. We had an incredibly strong consumer that helped support stock prices, all throughout the year. So, talking a little bit more about what we have on the slide here, you know, some sort of major themes, that occurred, right? The clear air turbulence, as we mentioned, 20% decline followed by 35% recovery, through the end of the year. What bubble, right? People were talking about a tech bubble and an AI bubble, pretty much all year. But there was no PE expansion that we saw, no multiple expansion, between sort of, January and December. All of that growth was really driven by fundamentals. It was driven by earnings, which is not indicative of a bubble. We'll talk more about that in a moment. And it wasn't just all AI, right? Despite the headlines, there was, a really, really impressive broadening that occurred, all throughout the year, especially sort of on the back half. If you look at the Mag 7, sort of from October till now, it's essentially flat. And there were only two Mag 7 stocks that outperformed the S&P 500. On the flip side, the impressive 493 have really carried the weight, since the fourth quarter of last year and into this year. And as I was looking at sort of the year-to-date returns, if you were thinking AI was the only game in town, it's materials, it's utilities, it's all the names that you wouldn't expect. And so, 2026, the theme this year, instead of CAT, clear air turbulence, it's risk awareness and diversification. So RAD is the theme that we're going with for 2026. We expect the broadening to continue, not just, US, but also, internationally. It's very rarely that we see 4 consecutive years of double-digit market returns, right? So we're 3 years in now, right? This would be the fourth. It's statistically very, very, very uncommon. However, GDP growth is supportive of double-digit returns, and so are earnings estimates. And we'll drill down further, into that as we go through the presentation. All that being said, risk awareness is still vital. Volatility will rear its ugly head. It's a midterm election year. We've got brand new sort of, tariff hullabaloo that's in the mix. And we, have a myriad other issues, including a new Federal Reserve chair, the potential for, what comes out of all this AI, what AI is, disrupting, software as a service being a big, primary component of that. And so, risk awareness is certainly a key theme. So looking at what we got right and sort of what we got wrong. So the expectations for returns last year were almost spot on. When we did our crystal ball outlook in Q1 of last year, it was nearly right on the money in terms of where the S&P ended up. Um, you know, there was a period of time in 2025, like right around April, where a lot of Wall Street analysts, cut their forecast in half or even more so. That wasn't the case. The expectation was that the tariffs were going to be, for lack of a better word, transitory, if not, illegal, which is ultimately what occurred, and that fundamentals would rule the day. And so, the consistent forecast of returns based on fundamentals, really got us to where we expect it to be, even without, multiple expansion or PE, expansion. We expected international, to perform well as well, and that was a combination of things. I mean, valuations were incredibly depressed, but at the same time, the expectation was that the dollar would begin to decline. And so we've got some more slides on that coming up. But international, performed very well. We had a reallocation early last year in February to sort of overweight international versus the prior model allocation, and we're pleased with that. The only thing that was sort of missed was the magnitude and persistence of the growth in Mag 7, right? So it's not that we weren't allocated to them. On the contrary, if you're allocated to the S&P, which is a core of most of our models, you've got a 30% plus allocation to the Mag 7 stocks. But that said, the persistence of growth and just how they've been able to grow revenue and more slowly their margins and profits was certainly outstanding and somewhat unexpected. But by and large, the forecast matched the results, and we're quite pleased about that. So looking at the 2026 base case, what we are looking at is real GDP growth of somewhere between 2.25% and 2.75%. We expect the federal funds neutral rate, right? So, the overnight financing rate, the rate that banks borrow from one another on an overnight basis, to end up somewhere between this 3 and 3.75% range, which implies a couple of cuts. We expect the 10-year Treasury to be, somewhere between 3.5, to 5, with an average around 4.25, which is not too far from today. And then 15% earnings growth in 2026, and then 12 to 15% in 2027. And so fairly like simple math here. If you're trying to do a forecast, you would take, hey, what's your PE ratio that you expect, right? The current is, 22 times earnings on the S&P. What is your earnings growth that's implied, right? And then what does that imply in terms of S&P level, right? Well, the base case is that, PE stays basically flat, 22, and then earnings of $350 a share, which would imply a 15%, growth in earnings. That would get you to 7,700, right? Which is, roughly 12% return, add in dividends, and it gets you to close to 13. So it's possible without any multiple expansion, if earnings growth is as expected, that we could get a four year in a row, double-digit S&P return. The optimistic case is that we see a little bit of multiple expansion. I think this, what this really implies, because of the way that the S&P is set up and how so much of the S&P is in the Magnificent Seven or Magnificent Eight, if you add in Broadcom, we will need to see them make good on the promise of artificial intelligence, right? If we start to see some of this stuff come to market, and really make an impact, then you could see some multiple expansion. But that's really the optimistic case. We only are assigning a 10% probability to it. The disappointing case is that we see PE contraction, right? And roughly consensus earnings, right? So in that sort of 350, 355 range. If we see contraction, but roughly equivalent earnings, that would put us at a basically flat year. 1% price return, 2% total return. And then the pessimistic case, which again we're assigning a fairly low probability to, is that PEs contract even further, right? So that's an 18 times PE ratio, and earnings of 310, right down from that consensus of 355. So again, a 10% weighting that we're applying to it, but that would be a very sort of disappointing year for sure. But again, a 10% weighting that we're assigning to it. So the base case is 7,700 on the S&P, which again implies double-digit returns. So as we're looking at the different sort of factors that, get baked into the forward-looking, returns. It's this FVT model, right? So fundamentals, valuation, and technicals, right? Those are the long-term drivers of returns in the market. So speaking of fundamentals, right, we've got, economic trends, which is, fairly neutral. Earnings, Fed policy, and interest rates, neutral to positive. Uh, Real rates, so interest rates adjusted for inflation, as well as M&A and IPO activity, fairly neutral. And then credit spreads neutral to positive. So M&A and IPO, I think, is the one that, could trend positive here in the near term. We're expecting three, really, really significant initial public offerings this year. Two in the AI space, which would be um, Anthropic and OpenAI. And then, of course, it's the merger of, xAI and SpaceX coming to market. That would really heat up sort of, the IPO on-ramp for other companies that have had pent-up demand. In terms of valuations, they're a little bit rich, right? If you look at, sort of a, 20, 30, 40, 50-year average, price earnings, dividend yield, price of sales, they're neutral to negative. And that was sort of the thing that we cited before, which is we don't really expect a ton of PE expansion, right? And if we're going to see double-digit returns in the S&P, it's really going to be driven by making good on the earnings growth estimates at, around 15%, which is consensus. And then in terms of technicals, this is, sort of like reading the tea leaves, reading the charts, right? So like the advanced decline, how many stocks are going up versus going down, stocks above their 200-day moving average, so stocks with lots of support that are, trending upwards, sentiment, so investor sentiment, long-term trend, and then, sector trends. By and large, it's neutral to neutral to positive. But again, this is the framework that we look at: fundamentals, valuation levels, right? And then the technicals. And so we'll sort of start to move through each of these segments here, and talk a little bit more about why those are either neutral or neutral to positive or neutral to negative. So starting with earnings, right? They've been strong. I mean, across the board, earnings have been trending up. The expectations for earnings, if you look at this sort of yellowish line, this is rolling 1 year forward. The orange is 2026. Right. And then that red, let's see here, the sort of gray one is 2027, right? They're all trending higher. I think the main thing to sort of think about, though, is, while earnings trend higher, how does that translate into margins, right? Profit margins, profitability. It seems like profit margins might be beginning to plateau, especially if you look at the S&P 500, not on an equal weight basis, but on its cap weight basis. So like for people who have listened to these webinars, over the years, there is a ton of concentration in the S&P 500. Over 30% is the Mag 7 or Mag 8, depending on how you define it. And so if those companies are plowing all of their free cash flow back into capital expenditure, so the build out of like AI infrastructure, right, that's going to impact profitability, right? There's not going to be as much profit to pass on to shareholders. And so, while earnings are growing, profitability is something that we really need to keep an eye on. And I think the market is going to keep a fairly short leash on these, hyperscalers in terms of, how far they let this go before the profitability really starts to pass through. So that's something we're keeping a very, very close eye on. One of the things that we're noticing in earnings, though, is that the contribution to earnings is really, really broadening out, right? So again, it's not the Mega 8, right, or Magnificent 7. The Mega 8 would be Mag 7, plus Broadcom. And just for posterity, that's NVIDIA, Apple, Google, Microsoft, Amazon, Meta, Tesla, and Broadcom. But look at the trend here, right? So like coming into 2024, right, the impressive 492, had negative earnings growth, zero earnings growth, it was tepid and kind of clipping up, but the direction of travel, looking forward, looks fairly strong. And this is really exceptional earnings growth estimates for the other 492. I mean, 29% earnings growth for Q1 26, 27 for Q2 26, et cetera. The direction of travel for the Mag 7, right, if you kind of just do a slope of that line, is trending in the other direction. And so the market is a discounting, mechanism, right? It's a forward-looking mechanism, discounting future cash flows, discounting future earnings. And I think that's what we're seeing in the price action across all these different, components of the S&P 500 that are not the Mag 7. So if we look at performance, earnings, and dispersion, right, the performance of the Mag 7 has just been absolutely, remarkable, right? So if we look at, 23 and 24, Mag 7 was 76%, 48% in 24. And then in 25, about, 23% up. The S&P sort of 493 has trailed significantly, right? Like the rest of, the world of stocks sort of in the S&P 500. And that should be no surprise to market observers. But if we look at the earnings growth sort of, going forward and year to date, the other, S&P 493 is really starting to catch up, right? And again, it's direction of travel, 40, 22, 24 from -4, 4, 10, and 11, right? So again, the market is a discounting mechanism and a forward-looking mechanism, and expectations, right, really rule the day in terms of price action. The other thing that's interesting to look at is like 23 and 24, the Mag 7, with the exception of, NVIDIA in 23 and Meta in 24, I mean, they were moving, pretty much in, fairly close to lockstep. Sort of the exception to this would have been Alphabet in 24. They kind of got left for dead because they weren't, buying into AI the way that everybody else was, but, that has certainly turned around. If you look at 25, right, there was only two stocks that outperformed the S&P 500. S&P is the green line. The two stocks are NVIDIA and Alphabet, right, on a catch-up trade from sort of the prior year. And then year to date, of course, like Mag 7, large cap US has struggled. And, at the same time, industrials, utilities, basic materials, they've all posted double-digit returns. So we're seeing this, this broadening of earnings, and you don't want to ignore the impressive, 492. So looking at value versus growth and thinking a little bit more about earnings, this is our, sort of, S&P 500, Q4 year over year estimate for, for earnings. And in the gray, sort of bars, these are your value stocks, right? And the green is growth. And so, of course, tech earnings are, expected to be astronomical, of course, right? But coming up shortly after is industrials at 27%, financials at 8, materials at 3, right? So the majority of this chart in terms of earnings growth is really those value sectors, which is what comprises the majority of that impressive 492, right? So again, direction of travel. And then 2026 year to date, right? Top performing S&P companies by sector, take a look, right? Of course, the top performing, let's see, 18% year to date on tech, right? But industrials, energy, consumer staples, materials, et cetera, all sort of, leading the pack. The one thing that's worth noting, though, is that there was a significant discount to historical averages in terms of the spread between growth and value. That started to come back to parity, but it's not there, and it's fairly clear that there's a passing of the baton that's occurring and a rotation out of what has really worked well in the prior 2-3 years. So, thinking about other factors that go into that, FVT model, fundamentals, valuation, and technicals, it's capital spending. I mean, the capital spending boom is, certainly underway. It's not a surprise. Everybody's hearing headlines about, data centers and all of the, all the CapEx that's occurring. I mean, it really is a pillar of support for the economy at this point. And there's good reason, for it. I mean, it's not just the fact that, there's this sort of, for lack of a better word, mutually assured destruction between these companies where, there's an existential threat to keep up with the other hyperscalers, right? Where, history would say if you don't keep up, you get left behind. But aside from that, sort of mutually assured destruction of capital expenditure, there's the O3BA, right? Or the One Big Beautiful Bill Act. There were massive incentives for spending on manufacturing and depreciation associated with these types of investments. And so it's no surprise that the spending is being done. We expect this year that capital expenditure will probably add 35 basis points to GDP growth, which is not an insignificant contribution. And then looking at the hyperscaler investment, 2024 CapEx, this is in billions, was 241. 2025, the expected final number of 414. 26 at 659, 727 and 27, 755 and 28. I heard a good anecdote about this sort of hyperscaler investment spending the other day, which was that, the Mag 7 or Mag 8, they basically looked at their free cash flow and said, okay, how much free cash flow do we have? All right, that's going into CapEx, like point blank period. The problem with that is that it can only last so long, and the market's really only going to put up with taking all of your, free cash flow and putting it into OpEx, without some sort of proof statement. And the proof statement is not necessarily revenues, right? It's profitability. one of the things that we have to look at with these hyperscalers is that historically these were asset light companies, right? They didn't have huge, fixed assets on their balance sheets, and therefore they didn't have a lot of additional expenses associated with it or debt that they had to service for building it out. That's not the case today, and a lot of these companies that looked like startup unicorns in terms of their balance sheet before are starting to look more like old line, manufacturing companies, or you could even use like the automobile industry in terms of sort of capex expenditure. So how much will the markets, you know, give in terms of time to really see the fruits of these labors? It's hard to say. But with the Mag 7 essentially being flat since October and what appears to be down on the year, it looks like they're not going to wait that long. Maybe we get 12 to 18 months before sort of the jury's out. But it's something we need to watch closely. And if you're an overweight, S&P allocation, or you've let these names sort of run in the portfolio, um, it's probably worth re-examining. I think that there's a sort of mentality right now, especially in the institutional investor class, uh, about this sort of wait and rotate idea, where it's like, hey, we don't know who the winners are going to be necessarily at this point. We know there most likely will be winners, but there will also be losers. It's very difficult to tell who it's going to be. And so, the wait and rotate idea is, don't just, stay where you are, find value in other places. And I think the story there has been in small cap and mid cap stocks, but also, international by and large. So, the average stock in the stock market, it still looks, fairly attractive. I mean, if we look at the S&P 500, cap weighted, right, where, 30% is Mag 7, it's trading at about 22 times earnings, which is above the historical average, but not like several standard deviations above. If you look at the equal weight S&P, it's at about 16.74, right? So, not necessarily expensive. Again, the average stock still looks attractive. If we look at the Mag 7 X Tesla, so take Tesla out, we're at about 28 times earnings, which again, is not cheap by any means, but it's certainly not dot-com bubble level, right? If you throw in Tesla, of course, the numbers get a little bit skewed, but there's good reason for that. As sort of robotics and everything else rolls out, and this expected SpaceX XAI, IPO comes to market. So all that is to say that, don't throw the baby out with the bathwater. The whole market's not overvalued. There's still a lot of attractive, opportunities out there. We'd be remiss talking about valuations not to speak about international. And so, one of the key themes with international stocks is that, so goes the US dollar, so goes international performance. And what you see here in the gray lines is periods of dollar decline, and then the sort of outperformance of international versus US. And they line up, pretty darn well. As the dollar is declining, international, sort of, catches up, right? And we've had this long stretch, call it 15-year stretch of US outperformance with a couple of blips in the meantime. But the dollar, a good reason for it is the dollar has been incredibly strong and it's starting to decline. So, there's no reason not to expect it, to 5% decline in the US dollar versus a basket of foreign currencies this year again. But that's not the whole story, right? So if we look at global equity returns, in the prior year, right, in 2025, the belle of the proverbial ball was the Eurozone, and that was a 41.3% return. Now, what were the contributors to that, right? Well, by and large, it was two things. It was multiples and currency, right? So the exchange rate, the US dollar declining, accounted for, close to a quarter of that return, right? The other, maybe two-thirds of it came from multiple expansion. So multiple expansion is that PE ratio. How many dollars are you willing to pay today for the expected future earnings of a stock? And it's kind of an interesting story with the Eurozone, right? There was a number of factors that played into this, right? There was fiscal stimulus, across the board in the Eurozone. Like the sort of best example is in Germany. So as a sort of component of all the things that were happening with NATO and Russia, Germany passed its first deficit spending bill in forever. And as a result, right, there was a sort of a broad re-rating of stocks in the Eurozone, and a lot of the other countries kind of followed suit. And so, that re-rating, resulted in multiple expansion and people expecting more dollars of earnings and willing to pay more in terms of multiple for it. What they didn't have was earnings growth. I mean, the earnings growth was tepid, at best. So that return was really, not a result of fundamentals, but a result of these other factors. If you look at the emerging markets, it's a different story, right? Earnings growth is really the driver of returns. in emerging markets. Yes, we did get a little bit of multiple expansion, and yes, we did get some help from currency, but not, the outsized factor was growth in earnings. China, completely different story. This was, multiples, expanding significantly. Earnings growth was tepid. And then Japan has been such an interesting sort of success case. For those who aren't like market observers, Japan had a 40-year basically, bear market. And they had to do some really, really serious reforms about, Japanese companies returning value to their shareholders, and they did it. And it's working. In conjunction with that, they've got a lot of sort of fiscal stimulus that's occurring. And as a result, the Japanese stock market has done quite well. And so, I think the key, sort of takeaway is that when you see international stocks outperforming, there's several factors that underpin it, right? Multiples, right? Earnings, currency, and then of course you can't forget, dividends, but not as large a contributor, by and large. And so, as we're looking at earnings growth and sort of skating where the puck is going, uh, you can see that, coming out, from the GFC to pre-pandemic, right up to, sort of 2020 before, earnings, sort of fell off a cliff globally. Um, the US was really, the driver, right? Followed by India and China in this case. Japan and the Eurozone lagged significantly. Earnings growth, pandemic to now, right, has been a little bit of a different story. I mean, we saw Japan and the Eurozone sort of trough, right, but then really pick up quickly. Eurozone somewhat plateauing, but the expectations, sort of coming out of last year is that all of that fiscal stimulus is going to result in earnings growth and GDP growth. India has been the most impressive, and the expectation on earnings growth there, is still quite high. And then, US and Japan sort of, neck and neck, with Japan slightly falling off versus the US. And then, a couple other thoughts on international. If we go back to 2022, you'd be surprised to see that, Europe and Japan have outperformed the US if you strip out NVIDIA. Right, minus NVIDIA, the US is lagging by, in terms of total return, let's see, 180 to 210, about 30 basis points, right, which is pretty significant. And then some themes that we think have, sort of a longer tail, right? That European aerospace and defense, right? The sort of like rearming of Western Europe is something that, we expect to continue. Taiwan technology, Taiwan semi, again, there's some fragility to that trend, but the Taiwan Semiconductors is just a superlative company in terms of what they've been able to create and their processes. And then developed market banks. I think a big part of this is that yields have increased, so interest rates have been increasing, and that allows banks to create a spread, which of course they monetize when they make their loans, and so that theme has worked well as well. And so we looked at fundamentals, we looked at valuation. Let's take a look at technicals. And so technicals are a little bit, sort of like, looking at the tea leaves, but we'll take a look at each of these. The first is investor sentiment. It's fairly bullish, right? So like moderately neutrally bullish at this point. And these are, essentially, the professional investor, the AII's, sentiment survey, looking at who's bullish and who's bearish. I think you got to take all surveys with a grain of salt personally, but, it's not, dramatically negative, for sure. The advanced decline, I think, is a sort of a better technical indicator. This is telling us, how many stocks are moving up versus how many are moving down. The S&P is trending sideways on the year, and the Mag 7 really since October, but the advanced decline line is really strong, right? There are still many stocks that are, advancing, over and above those that are falling, right? So from a technical perspective, that's quite strong. And then if you look at moving average, it's fairly tepid, right? So this is the percent of stocks that are above their 50-day moving average, or that have a positive trend, right? It's sort of a momentum measure. It is positive, right? But it's close to neutral, right? So the market is taking a breather, and there's healthy rotation under the surface, I think, is the key takeaway. And again, like looking at the S&P 500, it's easy to sort of get biased by the huge weighting that's allocated to the Mag 7 or the Mega 8. There's a lot that's occurring beneath the surface. Again, small cap, mid cap, industrials, basic materials, financials, up until recently, they're all sort of rotating into these other components of the market. So the market needs to climb a wall of worry. A wall of worry is healthy. And I think the pause that we're seeing in the hyperscalers and the mega caps is also healthy. This rotation into other components in the market is healthy. But we need to climb a wall of worries, right? Like, irrational exuberance, if you will, is not a healthy thing for the market, right? That's when things start to get bubbly and prices just kind of don't make sense. But what are the current, wall of worry items? Well, the headline worries are the Fed, of course. What's going to happen with Warsh and sort of, taking over at the helm. The labor market's a big one, right? Like, so goes the labor market, so goes the U.S. consumer, so goes the U.S. consumer, so goes the U.S. economy. Valuation, like where are stocks valued currently? Of course, the midterm elections and then tariffs. We've had a lot of headlines recently. Some of the wild cards that we're monitoring it, as the year goes on, the risk of rising rates. This is kind of counterintuitive because we expect interest rates to get cut by the FOMC. The reason this is somewhat curious is because the FOMC controls overnight rates, right? So short-term rates, right? The rate that banks borrow from one another on an overnight basis. They don't control long-term rates, right? Long-term rates are controlled by market expectations. And so if we think that we're going to see inflation start to, pop up and there may be some good reasons for it, we'll see, long-term rates rise. So, that's certainly something to monitor closely. The potential for recession, all signs point to a healthy economy by and large at this point, but it's underpinned by a lot of this CapEx, AI spending. I mean, if we're saying that that's going to contribute, almost a third of a percent of GDP growth this year, if something goes wrong there, there's a high likelihood that we could see GDP contract. And so I think that's something we need to keep an eye on for sure. And then, like, this will always be on the list, geopolitical uncertainty, right? That's always a wild card. So most of this is out of our control, right? So what do we, we can't control these items, but what do we focus on? Economic growth, employment, earnings, interest rates, and credit spreads. That's what we focus on. What we control, right, is what we do in financial planning and sort of the decisions that we make and how we allocate our portfolios and our cash and everything else that we do in our client meetings. So let's talk through some of these headlines first. I think the main point is that the Fed is your friend. And actually, just taking a step back, let's talk a little bit about tariffs first, because I don't know if we have a tariff slide in this deck. So, recently, everybody's, probably well aware that, Supreme Court ruled the original tariffs that President Trump laid out as, unconstitutional. He has now taken this Section 122 approach to the legality of tariffs, and we're at there was a 15% global announcement. We're at a 10% as of today, global tariff. But the Section 122 rules, they only last about 150 days. So the current administration will need to come up with, another, version, or they'll need to fight in court about this. But ultimately, what we saw in the prior year, what we see in the current year, tariffs at this level should not negatively impact growth or inflation. If they were at a much higher level, it'd be a different story. But at 10% or 15%, it shouldn't have an outsized impact on growth estimates and inflation estimates. So historically, talking about the Fed, the Fed is your friend. We're looking at this is like a chart we dusted off, that goes back to 2007 to 2015. These are periods in the length of time between the first cut and the next hike in the S&P performance. So, looking back at sort of, in this, recent '07 to, 15, it was 3,000 days. The prior was 1,200 days, right? And the annualized return, by and large has been positive. There have been some outliers, right? But historically, the Fed is your friend, right? The average number of days is 571, the median's 180, and the return is between 13 and 20%. And the way to think about this is as interest rates are falling, right? There is in like the world of investing, right? We have this concept called the risk-free rate, which is, for lack of a better word, like the free lunch. What do you get for, cash or CDs or money markets or US Treasuries, short-term Treasuries? As that rate is falling, right, investors are incentivized to take more risk, right? And what are risk assets? They're stocks. And so as the risk-free rate falls, right, more and more assets will sort of, typically pour into, higher risk assets like stocks, right, to compensate for the real return, right, or the return that you're able to achieve using a risk-free asset adjusted for inflation. And so the Fed is your friend. I think, Kevin Warsh, I wrote about this a couple of weeks ago. He's got a tough row to hoe in terms of, sort of executing on what the executive office has sort of mandated in terms of, interest rate policy. Um, the executive, branch clearly wants short-term rates lower. Uh, the problem is that the Fed doesn't operate on executive order; it operates on consensus. And so, Mr. Warsh's, major hurdle is he needs to make a compelling case, and he needs other people to buy it, right? If the other governors are going to vote for it, and it's going to be challenging if we've got fairly robust labor market, we've got, inflation trending lower, right, which is the right direction. We've got capital markets that appear to be liquid, and not, in sort of catastrophe outside of maybe the software as a service sector. Um, he's going to have to build consensus if they're going to get, closer to, I think, what the executive office wants, and that's going to be a challenge, especially if the current Fed chair decides to stick around on the board, but not as governor. So the labor market, right? The labor market is a mosaic of data. It is not just one data point like the unemployment rate, and you have to look at it, sort of across all these different metrics. Um, the big picture is that it is a low hire, low fire sort of world that we're in right now. And I think there's a lot of good reasons for it. A lot of it has to do with unknowns, and I think, the expectations around AI are, certainly playing into it. But if we're not at, full employment currently, we're very, very close to it. Um, the impact of immigration policy has certainly, helped with this. Um, and I wrote about this a couple of weeks ago too. In terms of employment and the sort of the labor market, even if we're not growing jobs significantly, as we did maybe in the year prior, or the year prior to that, the labor force is shrinking, and that's part demographics, part immigration. So if we've got less, job openings, but at the same time the labor force is declining on a percent basis, it's going to, effectively create some stability. Now, there's all sorts of other knock-on effects that are associated with that, particularly immigration. But the labor market appears to be strong. Now, if that changes, right, so would the forecast, because again, so goes the U.S. consumer, so goes the U.S. economy. Speaking of which, the affluent consumer is most certainly, in charge at this point of, uh, spending. What we're looking at here is, net worth of households, the top 1 percentile, it's just, increasing exponentially. The bottom, right, it had a nice bump in 2020 and 21, but it's sort of flattened out. And this was a direct result of stimulus and then wage inflation, right? Wages went up, we had stimulus checks, but then inflation stuck around. And so net worth has not begun, continue to climb. And this goes back to that K-shaped recovery that, we've sort of written and spoken about in the past, year, 2 years. Um, the top of the K is doing great. The bottom of the K is not. And, you know, that's not great for society. That's not great in a lot of different ways. But from a consumption perspective and a GDP perspective, it's perfectly fine. And that's not to, make a statement on whether it's right or wrong. The fact of the matter is that the top of the K-shape, the top 40% of income earners, they make up 74% of the income at this point. And that accounts for 61% of the spending, right? So what would cause this group of consumers to stop spending? Well, I think it's a couple of things. One would be job loss, right? If you don't have a job, right, you're probably less likely to, to go out and spend money. What would create that in sort of the white collar world? Well, it's probably AI catching up faster than people expect. So it's something to watch. But if the bottom 20 to 40 to 60% is struggling in terms of consumption, it still only accounts for about a third of the spending. And again, that's not a judgment as to whether it's right or wrong. It's simply the sort of fact of the matter. However, there is a sort of sign of hope, albeit a one-off and short-lived, for the sort of bottom deciles of the consumption ladder, which is that we're expecting a bumper crop of tax refunds this year. So the bottom right chart that you see shows, the average refund historically. This year, in 26 for tax year 25, we're expecting about almost $1,000 plus increase in the average refund. And the main reason for this is because the withholding tables that people have with their employer, they were not updated to reflect the O3BA or the Big Beautiful Bill in the calendar year. And so, no tax on tips, no tax on overtime, auto loan deduction, the enhanced SALT deduction increase child tax credit, the increase in the standard deduction, all of this was not adjusted in calendar year 25. So it should be a one-off thing because those withholding tables will include this in 26. But we expect an infusion of capital into the sort of bottom segment of consumers. And historically, what happens when that occurs, it gets spent, right? So that is both positive in terms of GDP, but also positive, or it could be a negative, or like a head fake, if you will, for inflation, right? So we want to keep an eye on that as well. Now, thinking about valuations, a little bit, this is not 2000, right? So like PE ratios, what we're paying for earnings, they're elevated. There's no doubt about it, but it's nowhere near what we saw in 2000. So what you see on the left-hand side is December of 2025, right? This is, the 50 largest companies, the S&P 500, average PE ratio of 32.5. And all of it pretty much, sort of consolidating in this range here with a couple of outliers. When we were in March of 2000, sort of like, close to the peak of the dot-com bubble, the average PE ratio was 50 times. And there were some companies that were 100 times earnings, right? This is simply not bad. Like we are not in that same environment. And while I think it's easy to draw that sort of, comparison to the advent of the internet versus, sort of, AI and general artificial general intelligence, from a valuation perspective, they don't match up. From like a world-changing perspective, they might, right? But from a valuation perspective, they don't. And so a couple more points in terms of the wall of worry, right? The midterm elections are this year. They will impact volatility, right? So midterm elections, they create a lot of volatility, but they don't create bear markets. And so what we're looking at here is, S&P 500, corrections 1 year following, correction performance by presidential cycle. So, year two, the, drawdown is more significant, right? But the performance 1 year later, typically makes up for whatever had occurred, during that period of time. So like expect volatility, right? It should, rear its head larger than normal. But that doesn't necessarily, itself make a bear market. And then I think another, important note would be to look at global yields, right? And so global yields across the board are sort of, unified, right? In the developing markets, they're all mirroring the same trend, which what this implies, this sort of, increase in yields is a sign of health, right? This means that investors across the globe are expecting growth, right? If you're expecting growth, then you're expecting a higher interest rate on your debt. And the bond market, historically sort of like, inside Wall Street baseball, people say that the bond market is the smart money, the, stock market is the dumb money. I don't, know that either one is the case, but, the bond market is certainly pointing towards, higher expectations of growth, and not just in the US, but globally and across the board. And so, a couple more slides here as we're sort of moving towards the end of the presentation. The average interior year decline is 14%, and it's more so in a midterm election year. However, the market finished positive 35 out of 46 years, right? Ending 2025. And like last year was a perfect example of this. We closed down 19% at the bottom of the tariff tantrum and ended the year up 18. So, just because we're seeing a lot of volatility, and again, midterm year, like expect it to occur. That does not necessarily, mean that we are now in a, dyed-in-the-wool bull market or a bear market or a secular bear market, right? That's simply not what it implies. It implies that there's, some degree of, agitation and, expectations are changing and rules are changing and people get freaked out about that. But it does not imply a bear market or the start of a bear market. So, expect volatility this year. And then I think, looking at, sort of tried and true investing principles, this is our diversification heat map, right? And so what you see here is, the best performing asset class, going back to 2011, and then the worst performing asset class. And of course, like very frequently, the best performer is the worst performer in the following year. And what you see in the middle here is asset allocation, right? Which is what we preach. Don't just own the Mag 7. Don't just own, international. We should have a healthy balance, of all the above. And where you end up is right in the middle, in terms of performance over time. What's interesting is that if you look at from 2011 to 2025, we look at the annualized returns and we look at volatility, there's only one sector which would have outperformed asset allocation on a risk-adjusted basis, which is large cap growth. And like, go figure. I think everybody's that has been watching the markets knows like Mag 7, Mega 8, whatever. They have outperformed, everything and for good reason, for fundamental reasons, right? What's changing is that, a lot of those companies are becoming asset heavy companies where they weren't in the past, right? And I think this sort of re-rating that's occurred since October to today, where sort of flat pricing is a reflection of that. But, large cap volatility was 14.7, return was 14.1. That's almost a one Sharpe ratio, or how many units of return are you getting back for each unit of risk that you're taking? Asset allocation at, 70 odd basis points. If you look at like real estate investment trust, right, it's 7% return on, 16 of volatility. That's a point 0.5, and it's a point 0.5 across the board with almost everything else. So, asset allocation is superlative versus pretty much everything else except for large cap. But through the lens of history, it's fairly obvious as to why. And then a final thought, what do we do in our planning, right? We figure out what are the most important things, the real world outcomes that matter in your life. And then our goal, right, is to match, those outcomes to time horizons. If we've got a year or 2 years before a major purchase, like a home or, sending a kid off to school or, you name it, the market could do anything. Over 1 year, the market could be down 37, it could be up 52. Bonds down 13 to up 33, even a blended portfolio down 20 to up 34, right? And so, you know, time is the best predictor, of results. And we do this in our retirement planning. We do this, in all of our goals-based planning. But, over 5 years, those returns, they tighten up significantly, right? Down 2 to up 29, down 2 to, up 18, 1 to 20. Over 10 years, the story is very similar, right? And over 20 years, it's even tighter in terms of correlation or in terms of results and outcomes or the range of results. And so, I think the sort of final takeaways, that I'd give everybody listening is um, the there's a lot more happening inside of the market than what had been happening in the prior couple of years. Like there has been a significant rotation that's occurred, small cap, mid cap, industrials, basic materials, financials, et cetera. Like the superlative 493 is catching up. There are opportunities in developed markets and emerging markets and a tailwind from currency, and also in emerging markets, a tailwind from earnings in addition to that. And the market so far has been fairly fair with the Mag 7 and the sort of Mega 8 in terms of the capital expenditure. We'll see how long that lasts, right? I think a year, 18 months. We need to see some returns in terms of profitability, not just revenue, but profitability in these big companies. But it's all things to keep an eye on, and the wait and rotate idea. I think makes a lot of sense right now. It doesn't make sense to try to have a crystal ball and pick the winners in an AI arms race when you can get, solid returns and solid valuations elsewhere as the sort of, mutually assured destruction plays itself out. So with that, I'll pop through the, disclosures briefly and pop this slide up. If there's anybody that has questions, you can drop them in the chat. I'll wait a minute, to see if any come up. Right. So I will stop the recording, and I'll wait around a couple more minutes to see if we've got any questions. But I'll take this opportunity to thank everybody for joining. Thank you for your business. Thank you for your trust. And I think we're going to try to do another, sort of version of this once we are able to rope in our colleague Jeff. So stay tuned for that. Thank you again and have a great day.